Howard Marks. The philosopher of risk. Howard Marks was born on April 23, 1946 in Queens, New York. The world he entered was still recovering from World War II. America was transitioning from wartime production to peacetime prosperity. The economy was booming with returning soldiers and new families. The stock market was beginning a long bull run that would last decades. Queens in 1946 was a working-class borough, full of immigrants and first-generation Americans chasing the American dream. Marks grew up in a modest middle-class Jewish family. His father worked as an accountant, a profession that valued precision, careful analysis, and understanding numbers. His mother was a homemaker who emphasized education and intellectual achievement. The family lived in Forest Hills, a neighborhood known for its tennis stadium and tree-lined streets. The Marks household was typical of post-war Jewish families in New York. Education was paramount. Books filled the shelves. Discussion and debate happened around the dinner table. Young Howard absorbed these values early. His father's accounting work exposed him to business and finance from a young age. He saw how his father analyzed financial statements, how numbers told stories about companies and their health. This early exposure planted seeds that would later bloom into an investing career. But the household was not wealthy. The Marks family lived comfortably but carefully. Money was discussed openly but with respect and caution. There was no sense of abundance or extravagance. This created in Howard a lifelong appreciation for risk management and downside protection. Howard was a bright child who loved learning. He was curious about how things worked, why people made the decisions they did, and what patterns existed beneath surface events. He was particularly drawn to reading, devouring books on history, philosophy, and eventually economics. He was not the most outgoing kid. He preferred thinking and reading to sports and socializing. But he was not withdrawn either. He had friends and participated in school activities. What set him apart was his seriousness, his tendency to think deeply about questions others took for granted. Teachers noticed his analytical mind. He asked probing questions. He wanted to understand not just what happened but why it happened. This intellectual curiosity would become his defining characteristic as an investor. Howard attended elementary and middle school in Forest Hills during the 1950s. This was the height of American prosperity and confidence. The economy grew steadily. The middle class expanded. Television brought the world into living rooms. The space race captured imaginations. But beneath the prosperity, there were tensions. The Cold War created anxiety about nuclear conflict. The civil rights movement was beginning to challenge racial segregation. These contradictions, this sense that surface stability could mask deeper instability, would later inform Marx's investment philosophy. He learned early that things are rarely as simple as they appear. That conventional wisdom is often wrong. That markets and societies move in cycles, not straight lines. In high school, Howard excelled academically. He was particularly strong in mathematics and writing. This combination, quantitative analysis combined with clear communication, would become his signature. He graduated near the top of his class and was accepted to the Wharton School at the University of Pennsylvania. Wharton in the early 1960s was already the premier business school in America. It attracted ambitious students who wanted careers in finance and business. Howard arrived there in 1963, just as American capitalism was entering a new phase. The post-war boom was still strong. Stocks had risen steadily for years. A new generation of professional investors was emerging, armed with modern portfolio theory and quantitative methods. At Wharton, Marks studied finance and accounting. He was exposed to the efficient market hypothesis, which argued that stock prices always reflected all available information. He learned about portfolio theory, which mathematically modeled risk and return. But even as a young student, Marks was skeptical of these theories. They seemed too neat, too clean. They assumed rational actors and perfect information. Real markets, he sensed, were messier, driven by psychology and emotion as much as mathematics. This skepticism would become the foundation of his investment philosophy. While his classmates absorbed efficient market theory, Marx was already questioning it. He graduated from Wharton in 1967 with a degree in finance. He had done well academically but had not yet found his calling. After Wharton, Marx continued his education at the University of Chicago Booth School of Business. Chicago in the late 1960s was the intellectual center of free market economics. Milton Friedman taught there. The efficient market hypothesis had its strongest advocates there. It was a place of rigorous quantitative analysis and faith in market rationality. Marx arrived in 1967 and completed his MBA in 1969. During these 2 years, he was immersed in the theory that markets are efficient and investors cannot consistently outperform. Yet even surrounded by this orthodoxy, Marx remained unconvinced. He saw too many examples of market irrationality. He watched the stock market boom of the late 60s, when speculative stocks soared on little fundamental basis. He saw investors making decisions based on emotion and momentum, not careful analysis. One of Marx's professors at Chicago was James Lowry, who had co-founded the Center for Research in Security Prices. Lowry was a believer in market efficiency but also recognized market anomalies. He taught Marx that while markets are generally efficient, there are moments of inefficiency that careful investors can exploit. This nuanced view, that markets are mostly efficient but occasionally irrational, became central to Marx's thinking. Another influence was reading the work of Benjamin Graham, the father of value investing. Graham had written The Intelligent Investor and Security Analysis, which argued that patient, disciplined investors could find bargains by buying assets below their intrinsic value. Graham's emphasis on downside protection and margin of safety resonated deeply with Marx. It aligned with his natural caution and analytical temperament. By the time Marx graduated from Chicago in 1969, he had formed the early outlines of his investment philosophy. He believed markets were generally efficient but occasionally irrational. He believed emotion and psychology drove markets as much as fundamentals. He believed the key to investing success was not predicting the future but managing risk and avoiding big mistakes. He believed patience and discipline were more important than brilliance or insight. These beliefs were still developing, still inchoate. But they were there. And they would be tested and refined over the next 50 years. After graduating from Chicago, Marx faced the question all young people face: what to do with his life? He knew he wanted to work in finance and investing. But in 1969, the investment industry was very different from today. There were no hedge funds to speak of. Venture capital barely existed. Private equity was in its infancy. Most investing was done by banks, insurance companies, and mutual funds. Marx needed to find an entry point into this world. His first job was at Citibank in their equity research department. This was 1969, and Citibank was one of the largest and most prestigious banks in America. Getting hired there was a coup for a young MBA graduate. At Citibank, Marx was assigned to analyze companies and write research reports. This was grunt work but essential training. He learned how to read financial statements in depth. He learned how to model earnings and cash flows. He learned how to assess management quality and competitive positioning. Most importantly, he learned the difference between a good company and a good investment. A company could be excellent but overpriced. A company could be mediocre but undervalued. The key was not finding great companies but finding mispriced securities. This insight, obvious in retrospect but not to most investors, would guide his entire career. Marx worked at Citibank from 1969 to 1978. During this time, he witnessed two major events that shaped his thinking. First, the 1973 to 1974 bear market, one of the worst in history. Second, the rise of the Nifty 50 stocks in the early 70s and their subsequent collapse. Both events taught him about market cycles, investor psychology, and the danger of consensus thinking. The Nifty 50 were 50 large-cap growth stocks that investors believed were so good they could never be overvalued. Companies like Coca-Cola, IBM, McDonald's, Polaroid. These stocks traded at 50, 60, even 80 times earnings. Investors argued these companies were so dominant, so well managed, that any price was justified. Marx watched this bubble inflate with fascination and horror. He saw smart people abandoning valuation discipline. He saw investors convincing themselves that this time was different, that traditional metrics no longer applied. And then he watched it collapse. In 1973 and 1974, the market crashed. The Nifty 50 stocks fell 60, 70, 80%. Polaroid fell 90%. Investors who had been certain these stocks could never decline watched their portfolios evaporate. The lesson was seared into Marx's brain. There is no asset so good that it cannot be overpriced. Valuation always matters. Overpaying for quality is still a mistake. These lessons would inform his entire career. The 1973 to 1974 crash was brutal. The S&P 500 fell 48% from peak to trough. Oil prices quadrupled due to the Arab oil embargo. Inflation soared. Unemployment rose. The economy entered a severe recession. It was the worst market since the Great Depression. For young investors like Marx, it was a baptism by fire. He watched fear and panic grip the markets. He saw investors selling everything regardless of value. He saw high-quality companies trading at absurdly low prices. And he learned that the best opportunities come when others are most fearful. This became a core principle for him. The worst time to buy based on psychology is often the best time to buy based on value. At Citibank, Marx also began to develop his writing skills. He wrote internal research reports that were read by portfolio managers and senior executives. He learned to communicate complex ideas clearly and concisely. He discovered he had a talent for explaining financial concepts in plain English. This ability to write clearly would later become one of his most valuable assets. His memos to clients would become famous in the investment world. But in the early 1970s, he was just a young analyst trying to make sense of volatile markets and learning his craft. He was building the foundation of knowledge and experience that would serve him for decades. In 1978, after 9 years at Citibank, Marx moved to a new opportunity. He joined TCW, Trust Company of the West, in Los Angeles. TCW was a smaller investment management firm focused on institutional clients. The move to California was significant. It took Marx away from the center of finance in New York and exposed him to a different investment culture. Los Angeles was more entrepreneurial, less tradition-bound. TCW gave Marx more responsibility and autonomy than he had at Citibank. He was asked to manage portfolios, not just write research. He was given the freedom to develop his own investment strategies. At TCW, Marx began focusing on convertible bonds and distressed debt. This was unusual at the time. Most investors focused on either stocks or high-grade bonds. Convertible bonds were hybrid securities that offered bond-like downside protection with stock-like upside potential. Distressed debt meant buying bonds of troubled companies at deep discounts, betting they would recover or be worth more in restructuring. Both strategies reflected Marx's emphasis on risk management and downside protection. He was not trying to hit home runs. He was trying to achieve good returns with limited downside. He was thinking about what could go wrong, not just what could go right. The 1980s were a transformative decade for American finance. Leveraged buyouts exploded. Junk bonds became a major asset class thanks to Michael Milken. Hostile takeovers dominated headlines. Greed and excess defined Wall Street culture. Against this backdrop, Marx quietly built his track record at TCW. He was not chasing the hottest deals or the biggest returns. He was buying mispriced securities that others overlooked. Convertible bonds of solid companies trading below fair value. Distressed debt of troubled but viable companies. His returns were consistent and strong. More importantly, his downside protection was excellent. In down years, he lost less than peers. This defensive quality would become his calling card. By the late 1980s, Marx had established himself as an expert in convertible bonds and distressed debt. His reputation grew among institutional investors. Pension funds and endowments allocated money to his strategies. He was not famous in the broader world. He was not on magazine covers or television. But among sophisticated investors, his name carried weight. He had proven he could generate attractive risk-adjusted returns. He had survived multiple market cycles. He had developed a coherent investment philosophy. And he was beginning to articulate that philosophy in writing. In 1990, Marks and a colleague named Bruce Karsh decided to form their own investment firm. They called it Oaktree Capital Management. The name came from a large oak tree outside their office window in Los Angeles. Oak trees are strong, deep-rooted, enduring. The name reflected the investment philosophy they wanted to build. Not flashy or fast-growing. Solid, patient, resilient. Oaktree would focus on alternative credit strategies. Distressed debt, high-yield bonds, convertible securities, private equity. The firm would emphasize downside protection and risk management. It would target institutional investors who valued consistency over huge upside. Starting Oaktree was a risk. Marks and Karsh were leaving the security of TCW to start from scratch. They had no guaranteed capital. They had to raise money from investors who did not know them well. But they had a track record, a clear strategy, and conviction in their approach. They raised their first fund and began investing. The early 1990s presented excellent opportunities. The savings and loan crisis had created a mountain of distressed debt. Real estate and corporate loans were available at distressed prices. Banks and government agencies were desperate to sell assets. For investors like Marks who understood value and had patience, it was a target-rich environment. Oaktree's first major success came in distressed debt investing during the early 1990s. The firm bought portfolios of troubled loans at 30, 40, 50 cents on the dollar. Many of these loans eventually paid off at 70, 80, 90 cents or more. The returns were excellent. The downside protection was strong. Investors took notice. Oaktree's assets under management grew. The firm hired more people. It expanded into new strategies. But Marks and Karsh maintained the same philosophy. Buy assets below intrinsic value. Emphasize downside protection. Be patient. Do not chase trends. Think about what could go wrong. Throughout the 1990s, Marks continued to refine his investment philosophy. He was influenced by several thinkers and investors. Benjamin Graham's emphasis on margin of safety and intrinsic value was foundational. Charlie Munger's focus on avoiding stupidity rather than seeking brilliance resonated. Nassim Taleb's work on randomness and black swan events confirmed Marx's skepticism of market predictions. But Marks was not merely synthesizing others' ideas. He was developing his own unique perspective on markets and risk. This perspective would be articulated most clearly in his memos to clients. Marks began writing memos to Oaktree clients in the early 1990s. These were not typical investment commentaries full of market predictions and stock picks. Instead, they were philosophical essays on investing, risk, market cycles, and human psychology. Marks wrote about second-level thinking, the idea that successful investing requires thinking differently and more deeply than the consensus. He wrote about the importance of knowing where you are in the market cycle. He wrote about the inevitability of cycles and the danger of extrapolating current conditions indefinitely. He wrote about the difference between risk and uncertainty. He wrote in clear, accessible prose without jargon or mathematical formulas. These memos slowly gained a following. At first, they were read only by Oaktree clients. But clients shared them with colleagues. Word spread. By the late 1990s, Marx's memos were being circulated widely among institutional investors. People like Seth Klarman and Joel Greenblatt praised them. Warren Buffett later said he always read Marx's memos first when they arrived. The memos established Marx as not just a successful investor but a deep thinker about markets. They showed he was reflecting on first principles, not just executing strategies. They revealed a philosophical temperament rare among money managers. One of Marx's most important insights was about risk. Most investors define risk as volatility, the up and down movement of prices. This definition comes from modern portfolio theory and is mathematically convenient. But Marx argued this definition misses the point. Real risk, he said, is the probability of permanent loss of capital. An investment can be volatile but not risky if you buy it at the right price. An investment can be stable but very risky if you overpay. Risk is not about price movements. Risk is about paying too much, about not understanding what you own, about making decisions based on emotion rather than analysis. This redefinition of risk became central to Oaktree's approach. Another key concept Marx developed was second-level thinking. First-level thinking is simple and superficial. It looks at a company and says, "This is a good company, therefore I should buy the stock." Second-level thinking is complex and nuanced. It says, "This is a good company, and everyone knows it is a good company, and therefore the stock is probably overpriced, and therefore I should not buy it." Second-level thinking considers what is priced in, what is expected, what the consensus believes. It tries to identify situations where the consensus is wrong. It recognizes that being right is not enough. You have to be right when others are wrong. This focus on contrarian thinking and market inefficiency became a hallmark of Marx's approach. Marx also emphasized the importance of knowing where you are in the cycle. Markets and economies move in cycles. Periods of growth and optimism are followed by periods of decline and pessimism. Periods of easy credit are followed by periods of tight credit. These cycles are inevitable. They cannot be eliminated. But they can be understood and navigated. Marx argued that successful investors must constantly ask, where are we in the cycle? Is optimism high or low? Are investors cautious or reckless? Are assets priced for perfection or for problems? By understanding the cycle, investors can adjust their behavior. Be aggressive when others are cautious. Be cautious when others are aggressive. Buy when assets are cheap and sentiment is negative. Sell when assets are expensive and sentiment is euphoric. The late 1990s tested Marx's philosophy. The dot-com bubble inflated to absurd levels. Technology stocks with no earnings and no clear path to profitability soared to multi-billion-dollar valuations. Investors abandoned traditional valuation metrics. They argued that old rules no longer applied. The internet was changing everything. Network effects and first-mover advantages justified any price. Marx watched this with a sense of déjà vu. He had seen the Nifty 50 bubble in the early 70s. He knew how this story ended. But in real time, it was difficult. The bubble kept inflating. Investors who remained disciplined looked foolish. Oaktree's returns lagged. Clients questioned the strategy. Marx refused to chase the bubble. He did not buy overpriced tech stocks. He stuck to his discipline. He bought distressed debt and high-yield bonds at reasonable prices. He maintained his focus on downside protection. In his memos, he warned about the bubble. He pointed out the absurd valuations. He reminded clients that trees do not grow to the sky. He emphasized that bubbles always end badly. But he also acknowledged the psychological difficulty of contrarian investing. It is hard to look wrong for an extended period. It requires conviction, patience, and strong clients who trust your process. Many investors broke during the bubble years. They could not stand being wrong any longer. They abandoned discipline and chased returns. Marx did not break. In March of 2000, the bubble peaked. Then it burst. Over the next 2 years, the Nasdaq fell 78% from peak to trough. Trillions of dollars of market value evaporated. Companies that had been worth billions went bankrupt. Investors who had been certain the internet changed everything watched their portfolios collapse. Oaktree, which had avoided the bubble, weathered the crash well. The firm's portfolios held up. Clients who had stuck with the strategy were vindicated. Marx's reputation was enhanced. He had called the bubble and avoided it. He had remained disciplined when others panicked. This experience reinforced his core beliefs. Valuation matters. Cycles are inevitable. Discipline is essential. Being contrarian is uncomfortable but necessary. The early 2000s also brought new opportunities. The bursting of the tech bubble created distressed debt in the telecom and technology sectors. Companies like WorldCom and Global Crossing went bankrupt, creating opportunities to buy debt at distressed prices. Oaktree deployed capital into these situations. The firm bought portfolios of troubled loans. It participated in restructurings. It earned strong returns as these investments recovered. This was Oaktree's sweet spot. Buying assets in unloved sectors at distressed prices. Waiting patiently for recovery. Earning attractive returns with limited downside. In 2001, Marx published a memo titled "You Can't Predict, You Can Prepare." This memo articulated his view that trying to forecast the future is futile. The future is unknowable. Too many variables, too much randomness, too much complexity. Investors who think they can predict the future are deluding themselves. But, Marx argued, even though you cannot predict, you can prepare. You can build portfolios that will do well in various scenarios. You can emphasize downside protection so you survive bad outcomes. You can maintain liquidity so you can act when opportunities arise. You can study history and cycles so you understand patterns. You can position yourself to benefit from others' mistakes. This memo became one of his most influential. It captured his philosophy in a single sentence. You cannot predict, but you can prepare. The mid-2000s were benign for markets. Credit was easy. Returns were strong. Volatility was low. Investors grew complacent. Marx watched with concern. In his memos, he warned that risk premiums were too low. Investors were not being compensated for taking risk. Credit spreads were tight. Junk bonds yielded barely more than treasuries. Investors were reaching for yield without demanding adequate compensation. Marx knew this could not last. When credit is too easy for too long, bad things happen. Borrowers take on too much debt. Lenders make bad loans. Risk builds up in the system. Eventually, something breaks. In 2005 and 2006, Marx wrote memos warning about excessive risk-taking. He pointed to rising leverage, loosening credit standards, and speculative behavior in housing and credit markets. He did not predict the financial crisis. He did not say when or how it would unfold. But he said the conditions were dangerous and investors should be cautious. At Oaktree, the firm reduced risk. It held more cash. It avoided aggressive lending. It prepared for opportunities that would come when the cycle turned. This was classic Marx. Not predicting the future, but understanding the cycle. Recognizing when risk was mispriced. Positioning for what could happen. The financial crisis of 2008 was the defining event of Marx's career. It validated everything he had been saying for decades. The crisis began in housing. Subprime mortgages, made to borrowers with poor credit, had been packaged into securities and sold to investors worldwide. When housing prices stopped rising and defaults began, these securities plummeted in value. Financial institutions holding them faced huge losses. Credit markets froze. Lehman Brothers collapsed in September 2008. The global financial system nearly collapsed. Stock markets crashed. The economy entered a severe recession. For most investors, 2008 was catastrophic. Portfolios fell 30, 40, 50%. Hedge funds blew up. Pension funds faced massive shortfalls. But for investors like Marx who had prepared, it was the opportunity of a lifetime. Oaktree had raised capital specifically to invest in distressed debt. When the crisis hit, the firm deployed billions of dollars. It bought corporate bonds at 30 and 40 cents on the dollar. It bought mortgage-backed securities at distressed prices. It participated in restructurings. The key was having capital when others did not. The key was having the courage to act when others were paralyzed by fear. In September 2008, as Lehman collapsed and panic gripped markets, Marx wrote a memo titled The Limits to Negativism. In it, he acknowledged the severe problems facing the economy and financial system. But he argued that investors had become too pessimistic. Asset prices reflected an overly dire scenario. Yes, things were bad. But prices assumed things would get worse than they likely would. This was the time to buy, not sell. It took courage to write this memo when the world seemed to be ending. But Marx understood market cycles. He knew that the best opportunities come at points of maximum pessimism. He knew that when everyone is scared, prices often overshoot to the downside. Oaktree's performance during and after the crisis was excellent. The distressed debt funds launched in 2008 and 2009 generated some of the best returns in the firm's history. Buying assets at 20 or 30 cents on the dollar and watching them recover to 50 or 60 cents produces tremendous returns. Clients who had trusted Oaktree's process were richly rewarded. The crisis cemented Marx's reputation as one of the great investors of his generation. He had warned about excess before the crisis. He had prepared during the crisis. He had deployed capital at the bottom. He had generated exceptional returns in the recovery. This was the complete cycle, perfectly executed. In 2011, Marx published his book, The Most Important Thing, Uncommon Sense for the Thoughtful Investor. The book was based on his memos and distilled his investment philosophy. It was organized around 20 key concepts, each labeled the most important thing. Second-level thinking. Understanding market efficiency and its limits. Value. The relationship between price and value. Patient opportunism. Knowing what you do not know. Each chapter explored a concept in depth with examples and insights. The book was a surprise bestseller. It resonated with both professional investors and lay readers. It became required reading in business schools and investment firms. The book established Marx as a public intellectual, not just a money manager. He was invited to speak at conferences and universities. He was interviewed by media outlets. His memos, always widely read among professionals, now reached a broader audience. He was recognized not just for his investment success but for his ability to articulate timeless principles about markets and human behavior. Warren Buffett wrote the foreword and called it must-reading. This endorsement from the most respected investor in the world confirmed Marx's status. After the financial crisis, Oaktree continued to grow. The firm expanded into new strategies and geographies. It opened offices in Europe and Asia. It launched funds in private equity, real estate, and infrastructure. By 2012, Oaktree managed over $80 billion. That year, the firm went public. Oaktree's IPO was unusual. Most investment firms that go public do so to cash out founders. But Marx and his partners sold relatively little stock. The IPO was mostly to provide liquidity for employees and to have a currency for acquisitions. Marx remained deeply involved in the firm and in investing. The 2010s were a challenging decade for Marx's style of investing. After the crisis, central banks kept interest rates near zero for years. They engaged in quantitative easing, buying trillions of dollars of bonds to stimulate the economy. This drove asset prices higher and compressed risk premiums. High-yield bonds and distressed debt offered little yield. There were few opportunities to buy assets at distressed prices. The market was expensive by historical standards. Investors were forced to reach for returns in riskier assets. Marx remained cautious. He emphasized that in an expensive market, the key is to avoid big mistakes, not to chase returns. In this environment, Oaktree's returns were solid but not spectacular. The firm generated mid-single-digit returns when the S&P 500 was generating high single-digit or low double-digit returns. Some clients questioned whether the defensive approach still made sense. But Marx was consistent. He argued that the goal was not to maximize returns in good times but to protect capital in bad times. Over full cycles, the cautious approach would win. It was the same message he had been delivering for decades. Be patient. Do not chase. Emphasize downside protection. Wait for opportunities. The cycle will turn. Throughout the 2010s, Marx continued writing memos. His themes were consistent: the danger of low interest rates and central bank intervention, the importance of understanding where you are in the cycle, the rarity of bargains in an expensive market, the need to focus on risk management, the inevitability of future downturns. His memos became longer and more philosophical. He quoted poetry and literature. He reflected on psychology and history. He acknowledged the difficulty of investing in an expensive market. But he never wavered from his principles. Value matters. Cycles are inevitable. Risk is the probability of permanent loss. Second-level thinking is essential. In early 2020, the world faced a new crisis. The COVID-19 pandemic caused governments to shut down economies. Stock markets crashed in March 2020, falling over 30% in a few weeks. It was the fastest decline in history. Panic gripped investors. But this crisis was different from 2008. Governments and central banks responded immediately and massively. They cut rates to zero. They launched trillions of dollars in stimulus. They backstopped credit markets. The downturn was sharp but brief. Markets recovered quickly. By late 2020, stocks were at new highs. The crisis created a brief opportunity but not a sustained one. Marx's response to COVID was revealing. He wrote memos acknowledging the uncertainty. He admitted he did not know how severe the pandemic would be or how long it would last. But he argued that markets had become too pessimistic. Asset prices in March 2020 reflected an extremely dire scenario. Even modest improvement would drive prices higher. Oaktree deployed capital but cautiously. The firm was not sure if this was the bottom or just a pause in a longer decline. In the event, markets recovered faster than almost anyone expected. The massive stimulus worked. Risk assets soared. Oaktree's returns were good but not exceptional. Some criticized Marx for being too cautious. But his response was consistent with his philosophy. He focused on downside protection, not maximum upside. As of late 2024, Howard Marks is 78 years old. He remains co-chairman of Oaktree Capital, which now manages about $200 billion. He still writes memos, though less frequently than in earlier years. He still speaks at conferences and is interviewed by media. He has become an elder statesman of the investment world. His influence extends beyond his firm. A generation of investors has been shaped by his writing and thinking. His emphasis on risk management, contrarian thinking, and understanding cycles has become mainstream in institutional investing. Looking back over Marx's career, several themes emerge. First, the power of consistency. Marx has articulated the same core principles for over 30 years. He has not chased trends or changed his philosophy. This consistency built trust with clients and credibility in the market. Second, the importance of writing and communication. Marx's memos are as much a part of his legacy as his investment returns. They forced him to clarify his thinking. They educated clients. They spread his ideas widely. Third, the value of studying cycles and history. Marx's understanding of market cycles allowed him to position portfolios appropriately and to avoid major mistakes. Fourth, the centrality of risk management. Marx did not generate the highest returns in bull markets. But he protected capital in bear markets. Over full cycles, this defensive approach produced excellent results. Marx's secret source of success was not superior information or brilliant insights. It was a superior way of thinking about markets and risk. He understood that markets are driven by psychology as much as fundamentals. He recognized that investor behavior is cyclical. He accepted that the future is unknowable and focused on what he could control, which was managing downside risk and being prepared for opportunities. He thought deeply about what it means to be a successful investor. Not predicting the future. not hitting home runs, but avoiding big mistakes, being patient, acting rationally when others panic, and building wealth steadily over time. One of the most important aspects of Marx's approach is his concept of second-level thinking. First-level thinking is simplistic. It says this is a good company, buy it. Or this is a bad company, avoid it. Second-level thinking is more complex. It asks, what is the market expecting? What is priced in? If this is a good company but everyone knows it, is it still a good investment? If this is a troubled company but everyone hates it, could it be a good investment? Second-level thinking recognizes that investment success is not about being right. It is about being more right than the consensus. You have to think differently and better than average to earn above-average returns. Marx often uses the example of a room full of people. If everyone in the room believes something, it is likely already reflected in prices. To profit, you need to see something others do not see. Or you need to interpret information differently. Or you need to have a different time horizon. This requires humility. You have to accept that sometimes you will look wrong for extended periods. Sometimes the consensus will seem right and you will seem foolish. But if your analysis is sound, if you are buying assets below intrinsic value with downside protection, then time will prove you right. This is extremely difficult psychologically. It requires conviction, patience, and supportive clients. Another key element of Marx's success is his focus on knowing where you are in the cycle. Markets and economies move in cycles. Periods of growth are followed by periods of decline. Periods of easy credit are followed by periods of tight credit. Periods of optimism are followed by periods of pessimism. These cycles are inevitable. They cannot be eliminated. But they can be understood. Marx believes successful investors must constantly assess where we are in the cycle. Are we early in a bull market or late? Is sentiment bullish or bearish? Are investors taking too much risk or too little? Are assets expensive or cheap? By understanding the cycle, you can adjust your behavior. Be aggressive early in the cycle when assets are cheap and sentiment is negative. Be cautious late in the cycle when assets are expensive and sentiment is euphoric. Marx tells a story about a market that gets hot. Prices rise. People make money. This attracts more investors. Prices rise further. Success breeds enthusiasm. Enthusiasm breeds carelessness. Standards slip. Risk-taking increases. Leverage increases. Eventually, prices become disconnected from fundamentals. The market is priced for perfection. Any disappointment causes problems. And disappointment always comes. Something goes wrong. Prices fall. Investors panic. Selling begets selling. Prices overshoot to the downside. Fear replaces greed. This creates opportunity. But most investors are too scared to act. Only those who understand the cycle can act rationally. They know that the best time to buy is when things look worst. The best time to sell is when things look best. This understanding of cycles led Marx to develop a framework for evaluating market conditions. He looks at several indicators. Valuation levels. Are assets cheap or expensive relative to history? Risk premiums. Are investors demanding adequate compensation for taking risk? Credit conditions. Is credit easy or tight? Investor sentiment. Are people bullish or bearish? Behavior. Are investors cautious or reckless? By synthesizing these indicators, Marx forms a view of where we are in the cycle. This does not tell him what will happen next. But it tells him how to position. In late cycle conditions, be defensive. In early cycle conditions, be aggressive. In mid-cycle conditions, be balanced. Marx is also deeply influenced by behavioral finance and the study of cognitive biases. He recognizes that investors are not rational machines. We are emotional beings subject to a host of biases. Overconfidence. We think we know more than we do. Recency bias. We extrapolate recent conditions indefinitely. Confirmation bias. We seek information that confirms our beliefs and ignore information that contradicts them. Herd behavior. We follow the crowd and find safety in numbers. Loss aversion. We fear losses more than we value gains. These biases cause systematic mistakes. They cause investors to buy high and sell low. They cause investors to overpay in bull markets and panic in bear markets. Marx argues that successful investing requires recognizing these biases in yourself and others. You must be skeptical of your own judgment. You must seek out contrary views. You must resist the urge to follow the crowd. You must accept that you will be wrong sometimes. You must build processes that counteract biases. Checklists, valuation disciplines, risk limits, diverse perspectives. The goal is not to eliminate bias, which is impossible, but to manage it. To make fewer mistakes than the average investor. To be rational when others are emotional. This is incredibly difficult. It goes against human nature. But it is essential for long-term success. One of Marx's most famous concepts is the idea that risk is not the same as volatility. Most of modern finance defines risk as volatility, the standard deviation of returns. This definition is mathematically convenient. It allows risk to be quantified and modeled. But Marx argues it is wrong. Volatility is just price movement. It tells you nothing about the probability of permanent loss. A stock can be highly volatile but not risky if you buy it at a low price. A stock can be stable but very risky if you overpay. Real risk, Marx says, is the probability of permanent capital loss. This is harder to measure. It cannot be reduced to a single number. But it is what actually matters to investors. Marx identifies several sources of real risk. Overpaying for an asset. Misunderstanding what you own. Excessive leverage. Illiquidity when you need to sell. Correlation of holdings in a crisis. Bad luck or timing. The key insight is that risk is often hidden. When everything is going well, risky portfolios look fine. They may even outperform. But when conditions change, when stress hits the system, risky portfolios suffer disproportionate losses. This is why Marx emphasizes downside protection. He builds portfolios that will survive bad outcomes. He avoids concentration. He avoids leverage. He buys assets with margin of safety. He may give up some upside in good times. But he protects capital in bad times. This leads to another key principle, asymmetry. Marx seeks investments with asymmetric return profiles. More upside than downside. You might make 3 times your money if things go well. You might lose 20% if things go badly. This is a good bet. Over many such bets, you will do well. The key is avoiding situations with the opposite asymmetry, where you might make 20% but lose everything. Even if the odds favor success, one bad outcome can be catastrophic. This focus on asymmetry is central to Marx's approach to distressed debt and high-yield bonds. He looks for securities trading at deep discounts to intrinsic value. The downside is limited by the distressed price. The upside is substantial if the company recovers. This is the definition of attractive risk-reward. Marx also writes extensively about the importance of patience and long-term thinking. In a world obsessed with quarterly results and daily price movements, he argues that investors must take a longer view. Good investments take time to work out. Companies need years to execute strategies. Markets need time to recognize value. If you demand quick results, you will be disappointed and you will make mistakes. Patience is a competitive advantage. Most investors cannot be patient. They face pressure from clients, from benchmarks, from their own psychology. If you can be patient, you can buy assets that others have given up on. You can wait for catalysts to unfold. You can compound value over time. But patience is not the same as stubbornness. Marx distinguishes between patience and holding on to losers. Patience means giving good investments time to work. Stubbornness means refusing to admit mistakes. The key is knowing the difference. This requires honest self-assessment. Why are you holding this investment? Is it because the thesis is intact and it just needs time? Or is it because you do not want to admit you were wrong? This is one of the hardest questions in investing. Marx suggests several tests. Has anything fundamental changed? Would you buy this today at the current price? Are you holding because of a rational assessment or because of ego? Being honest about these questions is essential. Throughout his career, Marx has also emphasized the importance of knowing what you do not know. This is a form of intellectual humility. The future is uncertain. Markets are complex. Predicting what will happen is extremely difficult. Marx argues that acknowledging uncertainty is a strength, not a weakness. If you know what you do not know, you can prepare for multiple outcomes. You can build margin of safety into your investments. You can avoid overconfidence. Conversely, if you think you know the future, you will take excessive risk. You will be overexposed to your predictions. When you are wrong, you will suffer large losses. This concept, knowing what you do not know, is related to the idea of a circle of competence. Warren Buffett talks about staying within your circle of competence. Marx agrees. You should invest in areas you understand, where you have information, experience, and insight, where you can evaluate risks and opportunities. When you venture outside your circle of competence, you are guessing. You may get lucky sometimes, but over time, investing outside your competence will cost you. The key is knowing where the edge of your circle is. This requires self-awareness and honesty. It is easy to overestimate what you know. The best investors are rigorous about staying within their circle. Marx's investment philosophy can be summarized in a few core principles. Think about risk first, return second. Seek asymmetric opportunities with more upside than downside. Emphasize downside protection and margin of safety. Understand where you are in the market cycle. Think like a contrarian. Buy when others are selling and sell when others are buying. Focus on what you can know and accept what you cannot know. Be patient and take a long-term view. Avoid overconfidence and respect the limits of your knowledge. Build a disciplined process and stick to it even when it is uncomfortable. These principles are simple to state but difficult to execute. They require discipline, courage, humility, and patience. Marx has demonstrated these qualities for over 50 years. Looking at Marx's career, it is striking how consistent he has been. He has not changed his philosophy to fit the times. He has not chased trends. He has not abandoned his principles when they were unpopular. During the Dotcom bubble, when growth investors were celebrated and value investors were derided, Marx stuck to value. During the long bull market after the financial crisis, when momentum and growth strategies outperformed, Marx stuck to risk management. This consistency has cost him in short-term performance at times. But it has built trust, credibility, and long-term success. Another aspect of Marx's success is his ability to communicate. His memos are masterpieces of clear thinking and clear writing. He explains complex ideas in simple language. He uses examples and metaphors. He quotes history and literature. He acknowledges uncertainty and nuance. He does not pretend to know what he does not know. This honesty and clarity have made his memos influential. They have educated a generation of investors. They have spread his ideas far beyond his own firm. In a world full of jargon and obfuscation, Marx's plain speaking is refreshing and powerful. Marx's writing also reveals his intellectual curiosity. He reads widely. He thinks about psychology, history, philosophy. He quotes John Kenneth Galbraith and Nassim Taleb. He references poker and bridge. He draws lessons from art and literature. This breadth gives his investment thinking depth. It allows him to see patterns and connections that others miss. It makes his writing richer and more interesting. It shows that great investing is not just about numbers. It is about understanding human nature, history, systems, and complexity. The relationship between Marx and his partner Bruce Karsh is also important. Karsh has been Marx's partner at Oaktree for over 30 years. While Marx is the philosopher and writer, Karsh is the operator and manager. Karsh handles day-to-day investment decisions and firm management. This partnership allowed Marx to focus on his strengths, thinking and communicating, while Karsh handled execution and operations. Great partnerships are often built on complementary skills. Marx and Karsh had such a partnership. They trusted each other. They divided responsibilities based on strengths. They built an enduring firm together. Marx's influence extends beyond Oaktree. Many successful investors cite him as an influence. Seth Klarman has praised his writing. Joel Greenblatt has said Marx is one of the few investors worth reading. Warren Buffett has called his memos insightful. A generation of institutional investors has absorbed his ideas about risk, cycles, and contrarian thinking. Business schools teach his concepts. His book is on recommended reading lists. His memos are studied and discussed. This intellectual legacy may be as important as his investment track record. One interesting aspect of Marx's approach is his focus on credit markets rather than equities. While most famous investors focus on stocks, Marx built his career in bonds, particularly high yield and distressed debt. This shapes his thinking. Credit investors think about downside first. They want to make sure they get paid back. They focus on balance sheets and cash flows. They think about recovery values in bankruptcy. This credit mindset, focused on downside protection, influenced Marx's entire investment philosophy. Even when he invests in equities, he thinks like a credit investor. What can go wrong? What is the downside? What is the margin of safety? The credit markets also gave Marx opportunities that equity investors did not have. When companies face financial distress, their bonds often trade at steep discounts. If you can assess the probability of recovery, you can buy bonds at 30 or 40 cents on the dollar that will pay off at 50 or 60 or 70 cents. This generates attractive returns with limited downside. It requires a different skill set than equity investing. You need to understand bankruptcy law, capital structures, creditor rights, restructuring processes. But the opportunities can be substantial. Marx mastered this niche and built a firm around it. Over his career, Marx has also seen the investment industry change dramatically. When he started in 1969, the industry was small and sleepy. There were no hedge funds to speak of. There were no private equity firms buying companies with leverage. There were no sovereign wealth funds deploying hundreds of billions. Information was scarce and slow. Investors relied on physical documents and phone calls. Today, the industry is massive and hyper-competitive. Information is instant and ubiquitous. Computers and algorithms dominate. Trillions of dollars are managed by professionals. This changed environment makes it harder to find edges. Marx has adapted by focusing on less efficient markets, like distressed debt and private credit, where information advantages and patient capital still matter. Marx has also witnessed multiple financial crises. The 1973–74 bear market. The 1987 crash. The savings and loan crisis. The Dotcom bust. The financial crisis of 2008. The COVID crash in 2020. Each crisis reinforced his beliefs about cycles, risk, and the importance of preparation. Each crisis created opportunities for those who had capital and courage. Marx's career has been defined by how he navigated these crises. He prepared before them. He deployed capital during them. He prospered after them. This is the mark of a great investor. In recent years, Marx has reflected on his legacy and what he wants to pass on. In memos and interviews, he emphasizes that investing is a craft that must be learned over time. There are no shortcuts. You need experience, judgment, discipline. You need to live through cycles. You need to make mistakes and learn from them. He encourages young investors to read, think, and develop their own philosophy. Not to copy others but to understand principles and adapt them to their own temperament and situation. He emphasizes that investment success is as much about psychology and behavior as it is about analysis and numbers. Marx is also realistic about the limitations of his approach. He acknowledges that his style works best in certain market environments. When markets are expensive and volatility is low, opportunities are scarce. His defensive approach may lag more aggressive strategies. But he argues that over full cycles, through ups and downs, his approach will produce superior risk-adjusted returns. The key is having clients who understand this and can be patient. This is one of the challenges of the investment industry. Clients often want short-term performance. They judge managers over quarters and years. But the best strategies require longer time horizons to prove themselves. One of the questions Marx wrestles with is whether his approach can be taught. Can you train someone to be a second-level thinker? Can you teach contrarian thinking and patient opportunism? Or are these qualities innate? Marx believes the principles can be taught, but executing them requires temperament and character that may be harder to develop. You need the courage to look wrong, the patience to wait, the discipline to stick to your process, the humility to admit mistakes. These are as much personality traits as learned skills. Still, Marx believes that studying the right investors, reading the right books, and thinking deeply about markets can improve anyone's investing. Marx's approach to risk is perhaps his most important contribution. He redefined risk for a generation of investors. Risk is not volatility. Risk is permanent loss of capital. This shift in thinking has profound implications. It means you should focus on downside protection, not on maximizing upside. It means you should think about what can go wrong, not just what can go right. It means you should buy assets with margin of safety. It means you should avoid leverage and concentration. These ideas seem obvious in retrospect. But they were not obvious to most investors before Marx articulated them. His writing made these concepts clear and accessible. Another important concept is the idea of market inefficiency. Modern finance teaches that markets are efficient. Prices reflect all available information. You cannot consistently outperform. But Marx argues that while markets are generally efficient, they are not always efficient. There are periods of inefficiency driven by psychology, emotion, and behavioral biases. These periods create opportunities. The key is recognizing them. When assets are priced for perfection, when everyone is bullish, when risk premiums are low, markets are likely overpriced. When assets are priced for disaster, when everyone is bearish, when risk premiums are high, markets are likely underpriced. This is not about predicting the future. It is about assessing current prices relative to fundamentals and long-term averages. Marx also emphasizes the importance of luck in investing. He acknowledges that even great investors benefit from luck. Being in the right place at the right time. Having capital when opportunities arise. Avoiding disasters. Meeting the right people. This is not to diminish skill. Skill matters enormously. But luck also matters. The best investors create conditions where luck can help them. They build networks so they hear about opportunities. They maintain liquidity so they can act when luck presents chances. They position portfolios defensively so they survive bad luck. In this sense, you can prepare to be lucky. You cannot control luck, but you can maximize your chances of benefiting from it. Looking at Marx's investment record, it is difficult to calculate precise returns. Oaktree manages many different strategies with different risk profiles. Some are more aggressive, some more defensive. Some invest in public markets, some in private. But broadly, Marx's funds have generated mid to high single-digit returns over long periods. This may not sound spectacular, but these returns have been achieved with below-average risk. The funds have held up well in downturns. They have protected capital when markets fell. Over full cycles, the risk-adjusted returns have been excellent. This is exactly what Marx preaches. Not the highest returns, but strong risk-adjusted returns that compound over time. Marx has also been successful in building a business. Oaktree grew from a small startup to a firm managing $200 billion. It went public. It created wealth for employees and partners. It built a brand and reputation. This required not just investment skill but business skill. Raising capital, hiring and retaining talent, building infrastructure and systems, managing a public company, navigating regulations. Marx and his partners succeeded on all these dimensions. They built an enduring institution, not just a track record. As of today, Marx remains active. He still writes memos, though less frequently. He still speaks at conferences. He still thinks deeply about markets. But he has also stepped back somewhat. He is in his late 70s. He is thinking about legacy and what comes next. Oaktree has a deep bench of talented investment professionals. The firm will continue after Marx. But his influence will always be felt. His memos will continue to be read. His ideas will continue to shape investors. His philosophy will endure. Marx's story is a testament to the power of clear thinking, discipline, and patience. He did not have inside information. He did not have a secret formula. He did not rely on brilliance or genius. Instead, he developed a coherent philosophy. He thought deeply about risk and cycles. He acted rationally when others panicked. He avoided big mistakes. He built a process and stuck to it. He communicated his ideas clearly. He educated others. This approach, sustained over decades, produced extraordinary success. The lessons from Marx's career are clear. Think about risk before return. Understand where you are in the cycle. Be contrarian but not reckless. Focus on downside protection. Buy assets with margin of safety. Be patient and take a long-term view. Accept uncertainty and know what you do not know. Build a disciplined process. Communicate clearly. Never stop learning. These lessons are simple but not easy. They require discipline, courage, and wisdom. But for those who can apply them, they offer a path to investment success. Marx's legacy is secure. He is recognized as one of the great investors of his generation. His writings have influenced thousands of investors. His firm has generated billions in returns for clients. His ideas about risk, cycles, and contrarian thinking have become mainstream in institutional investing. But perhaps most importantly, he has shown that investing is not about magic or genius. It is about discipline, rationality, and a clear-eyed understanding of markets and human nature. This is a message that will endure long after Marx is gone. It is a message that every investor should take to heart.